The Nigerian stock market finished Friday with an upside that shows the Nigerian exchange all-share index heading to a positive year-end date of about 16%. But while that figure looks good on the upside, the downside on inflation, exchange rate, and higher interest rates bring a lot of dampener into the mix. Overall, the year 2020 is winding down on Friday, so I asked investment expert and licensed dealer Johnson Chukwu to come on the show tonight for a discussion. Johnson Chukwu is also the Chief Executive Officer at Carry Asset Management. Good evening to you, sir, and hope your holiday is going well.
Thank you. Yes, my holiday is going very well. You can see my dressing indicates I'm in a holiday mood. Merry Christmas to you and to Nigerians.
Thank you. Your mood shows you must have made some very decent returns on your investment this year. But give me what you consider the overall assessment of the financial markets in the outgoing year.
Well, interestingly, the Nigerian financial market did relatively well compared to what happened elsewhere. And like you pointed out, at the end of trading on 23rd of December this year, the Nigerian exchange had gained 16.36%, which is completely at variance with what has happened elsewhere in the world, where most bourses actually declined in the year. Even if you look at our fixed income space, you also observe that our fixed income space has not, price has not moved significantly in the current year, unlike what has happened elsewhere in the world. So on a balance, compared to what obtained in other parts of the world, one can conveniently say that the Nigerian financial market did relatively well in the current year.
Yeah, when we talk about the financial markets, it's not just about the stock market. What about the wider market? You've got the central banking interventions, you've got the money markets, you've got the rest of the market. Walk me through the various markets. Give me a sense of how the year actually performed despite the challenges, even within the broader economy itself.
Okay, let's start from the capital market that I mentioned earlier, where I said that the market had gained about 16.36% at the end of trading on 23rd of December. If you now move to the fixed income space, you now segment the fixed income space into the money market sub-segment and the debt market or the longer tenured instruments. At the money market segment, we saw inflation rate drive up in interest rates. We saw the central bank move interest rates and then gradually, in the TB space. And interestingly, by December, they had brought down the interest rate again, obviously because there was a lot of liquidity, and that liquidity was looking for where to invest. But at the deposit space, we saw interest rates move up as a result of the inflationary pressure, as a result of tightened monetary policies of the central bank that denied the banks of liquidity, and the banks were kind of scrambling for deposits. And at some point, large ticket depositors were now the ones calling the shot. They were the one determining the price at which they were going to sell their funds. But that seemed to have moderated. At the longer end of the market, where you have the bonds, you observe that the bond yield in Nigeria did not move significantly in the entire year. If you look at where the bond yield was at the beginning of the year and where they were at the close of trade on last week, you observe that, for instance, the FGN 2050 bond is still trading about 14%, which is what it opened at the beginning of the year. And the entire federal government debt instruments yield are ranging between 13.5% and 14.5%. And that was marginally higher than what they were where they opened at the beginning of the year. This was despite the fact that we've seen inflation rate move to 21.4%, and we've seen local currency depreciate, principally because investors do not have alternatives. They don't have the liberty to move to other market spaces like Ghana, where yields are quite attractive.
Great. But again, when you look at the market itself, the government was borrowing furiously from the domestic market rather than going to the Eurobonds this year. What did that tell us about the ability of the financial markets locally to support the government at all levels, as it were?
Well, what I would say is that because of the fact that our currency is not convertible, you realize that fund managers, which include the banks and the pension fund administrators, insurance companies, and other fund managers, institutional fund managers, are limited to Nigerian investment instruments. So that gives the government the latitude to come to the market to borrow. And as you saw, the government entirely, all its borrowing were either from the financial market or from the central bank. The federal government could not access the Eurobond market, of course, because of the current global economic environment and the fact that the yield on federal government debt bond on the yield at which the government can access Eurobond is quite high. So the local market remain attractive largely because of lack of convertibility of the local currency. And that simply meant that investors here, all institutional investors, were limited to whatever is available within the local space. And that's why you saw the government was able to raise the money they did. But beyond raising money from the financial market, I also know that the federal government borrowed massively from the central bank, because I also think that should they have come to the financial market to borrow the entire deficit of the budget, that would have overheated the financial market, and I don't think it would have denied, they would have completely crowded out the private sector from accessing funds in the market.
Yes, that would have happened, but again, how much impact did rising inflation and exchange rate has on investment markets in the year? If you look at exchange rates, officially we're just about 4.5%, but if you look at the private markets, that's a lot worse.
Yes, what happened is that, interestingly, because foreign portfolio investors have largely exited the market, and we are talking about an global economic environment where foreign portfolio investors were winding down their investment portfolios in emerging markets and moving back to secure market because of increase in yield in the US. So what we saw that the inflationary pressure we had here initially led to an uptick in interest rate, which I did mention earlier. The money market rate went up, and I know some banks are taking funds or buying tailored funds at much higher yield than they did. Some banks could buy tailored funds at up to 18% currently, principally because of some liquidity pressure they are going through, and the fact that large ticket depositors now have the bargaining power to insist on yield that will at least compensate for, to some extent, not fully compensate for inflation rate. Because, of course, if you look at the true yield, effective yield here in the country, is still on a negative when you compare that to inflationary pressure. But the inflationary pressure ultimately drove up interest rates. Interestingly, like I said earlier, we did not see so much movement in the bond space. But what had happened was, because no institutional investor would want to give money on long-term basis at rates that are below inflation rate, you realize that corporate borrowers now became active in the shorter end of the market, where they were actively issuing commercial papers. So on the balance, we saw low activity in the primary market segment of the bond sub-segment. We saw a lot of activities in the short end of the market, the money market segment, where you see commercial paper issuances. All this were as a result of the macroeconomic environment, where we saw high inflation rates and demand for compensation for the diminution in the value of the currency as a result of exchange rate depreciation and high inflation rate.
Oh, okay, let's chat a little bit more about the debt market, where you have the Debt Management Office being a major player or issuer of debt papers on behalf of the Nigerian government. What were the key developments in that particular space in terms of how the primary market performed in the year? Do you think the DMO actually met overshoot its calendar for the year?
Yes, if you observe that the DMO was coming to the market on a monthly basis with new instruments or the issuance of existing instruments, and they canned it all towards the end of the year in November, when they came to the market to issue 100 billion naira Chukwu bond, 10-year Chukwu bond, which was interestingly oversubscribed to the tune of 165%. So you had a subscription about 165 billion, but eventually the total sales was about 130 billion naira at 15.64%. So what you saw was, in terms of the bond market, it was largely the DMO that was active in the primary market of that market segment. The private sector bond issue, I think there was only one special purpose vehicle bond issue that occurred. If I'm correct, I think only one pattern that occurred in the year. Because like I said, no private sector business person or institution will want to come to the bond market and borrow at the time when yields are quite high. We saw federal government debt instruments. Of course, they are less risky at about 14.5%. That was after we saw a decline because of scramble for those instruments towards year end. But during at the beginning of the war and mid-year, we saw yield on those bond instruments go up materially, and that discouraged private sector investors. Like we also know that when the federal government is active in the bond market, they crowd out the private sector, because what they do, they bid up the price of debt instruments, and when you add a risk premium, the private sector investor need to pay to access same tenured instruments. No private sector investor will come into the market. And private sector investors stayed in the short end of the market where they largely issued commercial papers.
So here we are with the fixed income market portfolio for investors. Broadly speaking, the last few years we've seen retail investors jump into that market because yields were so attractive. Were we able to maintain that in the year 2022, or do you think institutional investors begin to edge out retail investors in the fixed income space because things were beginning to change and the fixed income space are no longer as sweet and juicy as it were in the last 3 to 5 years, at least in particular for local retail investors?
Yes, for local retail investors, I think most of them stayed in the short end of the market, the money market space. Institutional investors were quite active in the bond market. The likes of the pension fund administrators, the banks, the insurance company, they weren't active in the long end of market segment, that is the bond market. Aside from the Sukuk bond I mentioned earlier, which is a field of play for retail investors, where we saw so much retail investor participation, even as the offer was materially below the inflation rate. I mean, the yield at 15.6%, 64% was far below the inflation rate at that time, which was something like about 21%. But that, irrespective of that, we saw retail investors active in that space. Of course, we know a Sukuk bond comes with other attributes. It's an ethical bond, and those who have issues with interest payments will naturally come to that market space. And I think that contributed to the oversubscription we saw there. But in terms of the other bond instruments, other federal government bond instruments, in the first place, the minimum ticket for investment in the primary segment of the market make it unattractive for retail investors to come in unless they have huge deep pockets as to even come in the second market of that of the bond space. So I think today yield added to the minimum investable ticket for ordinary federal government bonds, not the Sukuk bond that has low entry point, or the federal government savings bond that have low entry point. But for the federal government bond, then the entry point is quite high for retail investors. And I also mentioned the fact that the yield environment did not encourage retail investors to be active in that space.
Yeah, with inflation, interest rate, and all of that, and exchange rate, a lot of deep pockets have gone really shallow in the year, if you ask me. And I'm sure you know that so much more being a market professional. But let's talk to the big headlines and the secondary markets on equity side when we come back. We've got a few headlines to touch on when we come back. Johnson Chukwu of Carry Asset Management is still on the show after the break. Drilling into the Nigerian financial markets in the year 2022 tonight is Johnson Chukwu, the CEO and head of dealing at Carry Asset Management. Johnson, thank you so much for coming through, sir. We appreciate that. Let's continue this conversation. You talk about the equities market. I'm looking at the major developments from both the regulatory side and the securities exchanges. What's new in the year 2022 for you?
Well, what was new in the outgoing year is that one, we saw the demutualization of the exchange, which transformed it from a members-owned company to a privately publicly quoted company with shareholders, like every other publicly quoted company. We also saw improvement, further deepening of the quality in terms of corporate governance that arose as a result of the demutualization of the exchange. And we also saw towards the end of the year a new capital market roadmap that will now chart a new course that is now focusing on digitalization of the market and adoption of digital technology, as well as introduction of digital products into the market. So what would I say is that the market in the current year was kind of went through a point of inflection where the market is moving to what you may call the global trend in the exchange worldwide. The mutualization is a major landmark in the data transformation or transmutation. Then the capital market roadmap, the revised capital market roadmap, is another major success that we can say we achieved this year. Then we also saw some listings of new instruments into the market that further broaden the choices of investors on instruments they can invest in. So I think what we saw was, one, improvement in corporate governance, two, reposition the market to be a global market, and three, improving on checks and balance of controls, and as well as position the market to be a digital market.
So this is 2022. Would you say that the digital space, the crypto, the Bitcoin folks took a bit of your lunch this year? For those of you who are traditional securities trading firm, trading vanilla, whatever, stocks, equities, bond, and what have you. Is this a year that you felt the pressure? How did you folks survive this year? Of course, you are no career assets folks. You launched a couple of mutual funds this year. Was that part of re-entry into the market? Is that a way of rebirthing yourself in the market, providing alternative window for investors? How is the business of securities trading?
You know, when I was talking earlier, I talked about that some of the major changes in the market, some of the major transformation we witnessed was the capital market, the revised capital market roadmap.
Master plan, yes.
For some of us, that has been our strategic intent, not just strategic intent, our strategic direction for a couple of years. And one of the things that major forward-looking capital market operators have done is to digitize their entire process and ensure that you reduce to the minimum human interface in terms of relationship with your customers and in terms of execution of trade, and as well as adoption of new products that are basically digital. If you observe, the capital market witnessed some pushback when some fintech operators began to trade securities without being listed on the exchange. But I was quite happy when the market decided to license some of those operators as sub-brokers so that they can actually trade digitally. For us in Cavalry Asset, one of the things we've done earlier, ahead of those interventions or foray of the fintech operators into our space, is to adopt the same technology they have to enable our customers to be able to do a lot of the transaction digitally. So I think for an operator that is forward-looking, that is strategic, you shouldn't be taken by surprise. The impact of digitalization on the exchange or on the market, as well as the encroachment of the fintech operators in the market space. Those were most expected in the past couple of years. And some of us are actually positioned to make sure that we do not just compete, we actually out-compete. We adopt and integrate financial technology into our operations.
So here we are with the NGX, just a few days before Christmas, got approval from the SEC to set up what you call the NGX technology, a board. What does that mean in terms of what you're talking about, of the fact that, look, there are tech guys, young generation of investors are here. They don't want T+3, they don't want T+2, they don't want T+1, they want T+0.
Yes, absolutely. Because when you talk of digitization, you're talking of the speed of service.
Yes.
You're talking of minimal human interface, and because there's no minimal, and you're talking of blockchain technology, where execution is at the speed of light. So, and introducing the board, the digital board, is basically to say, look, the market, like I said earlier, is forward-looking. And when I mentioned that the market had to license some of the fintech operators as sub-brokers, so that we will integrate them into the market. What that means, what we're looking at is that we're going to have some of those digital operators listed on the exchange as a subgroup. And we want to encourage such listing. We want to encourage such market participation because, Bosin, the world is going digital. Virtually everything you're doing now, if you're not digitized, you are out of business. And those of us as market operators have long recognized this, and I'm happy that the exchange and SEC are both recognize that, and we're doing everything to create an environment, create a market structure to allow them to get listed and to allow investors who want to invest in those instruments the opportunity to invest them in a transparent manner.
So if you look at the year, what sentiments impact bargain hunting in the year as we head to a close in the next few days? And do you think those sentiments will remain strong in the new year despite the overarching politics and elections in February and a new administration in June?
You know, interestingly, for us as a country, the economy, despite the turns and twists the global economy has had, despite the pressures that retail investors are facing today, we still saw the operating businesses that are quoted on the exchange record favorable and improved performances. We saw even some institutions that had never paid interim dividend for the first time in their history. The Fidelity Bank was one of those institutions that paid interim dividend for the first time in its history. And we saw the likes of Access Bank, Zenith Bank, First Bank, many of them coming to, Zenith Bank, Access Bank, and a couple of other such institutions declare interim dividend. So this declaration of benefits actually incentivize investors to start hunting for this instrument. That's what actually led to the bargain hunting you saw towards the end of the year, because investors are confident that if you look at the third quarter report of many of the operating businesses that are quoted on the exchange, the third quarter reports actually further improvement on the second quarter reports. And that's indicative of the fact that at the end of the first financial year, many of these companies will actually declare improved benefit to investors. And that has incentivized the market rallies we saw in the past couple of days. Again, the money market instruments, I mentioned earlier that from about 14.8% TBS yield for 364-day bills, the last auction was about 13.3% or thereabout, which meant that investors who are investing in an instrument that will give them dividend yield of maybe 10, 15%, and with prospect of capital appreciation, would rather stay in the equities market than stay in the fixed income short end of the money market. So we have a couple of incentives, despite the fact that these returns are below inflation rate. But in terms of ranking, the returns we're expecting from a couple of quoted companies in the on the exchange are actually trump over fixed income returns, and the better of the return, the yield we have in the market.
Okay, great. Johnson, the markets will be reopening on Wednesday. So you've got Wednesday, Thursday, and Friday. It's going to be a very big day on Friday. I realize the market will be closed with a one spectacular Nigerian. We're going to be there on the floor for Friday, the final trading day of 2022. Keep an eye on that. We're grateful for this robust review of the markets in the current year. Thank you so much. Have a pleasant evening.